feedback form, please. Good.
Make sure that you sign in for this session.
And sign in form as well.
Those of you online, can you just let me know if you can hear and see, please? Session.
Yes, Caroline, we can hear and see you.
Yeah. Lovely. Is everybody back? Do you want to sign in session 3? How do we know? I will need to chat. So I'm going to hand over to Ray. You got your click up yet?
Yeah, I think we're good to go. We've got the clicker.
Yeah.
Everyone can see us as the camera on.
Oh, you might need to hit the camera button on that one. There you go.
Oh, there we go. You can see us in the room now. So, thanks guys for having us. Great to have you in the office, and thanks for those that have joined us online. Presentation today is entitled Performance Anxiety. You'll all be pleased to know that this won't be a men's health session about my journey. So I'm sure you'll all be relieved to that. But rather, obviously, you know, probably an interesting time in markets. We've got the Trump news cycle. You know, we've had a small pocket of the Mag 7 of driven returns for a couple of years. I guess the question from there is, you know, can that continue? Uncertainty around sort of key economic data, and hence, you know, potentially some anxiety around portfolio performance and where to from here. So in terms of the presentation today, we've got the usual disclaimer there, but just wanted to touch on sort of recent macro and market drivers. Obviously, Trump seems like he's been president for a long time, but it's actually been 5 weeks. That shocked me, and sort of some potential growth opportunities beyond that Mag 7. But if there's any questions as we go along, don't hesitate to sting out, and we can discuss them. But you know, a few things to consider today. Obviously, sort of as I said, Trump now elected has definitely hit the ground running. There's a lot happening on the policy front and the executive order front. I'm sure you were familiar with the news. You know, the market wobble recently with DeepSeek and potential competition in the AI space and whether it's more efficient. You know, that may be an overreaction, but you know, on the day that was announced, Nvidia fell in terms of market cap $600 billion. So it's pretty crazy to put that in the context of that's the equivalent of losing the entire market cap of CBA, BHP, CSL, NAB, Westpac, Macquarie, and ANZ all in one day. And this is how big this company has become in terms of the United States. And look, the starting point where we sit today, I've just got a graph there of the Schiller PE ratio. So in terms of valuations, we are at kind of not quite tech rep type highs, but the starting point in terms of that's pretty extraordinary in terms of a historical context. So that Schiller PE, for those that sort of aren't familiar, unlike a sort of trailing or a forward 1-year PE, it takes into account the last 10 years earnings and it's inflationally adjusted. So the idea behind it is to take out some of the cyclicality in earnings to get a different idea of valuation. But you can see from that chart, the starting point's quite high. Even on a 12-month basis, you know, the S&P 500 is probably sitting at a 30 times PE today. Not quite as high as this measure, but still high in a historical context when you think the long-term average sits somewhere in terms of like around that 19 type level. So from that perspective, where we sit today looking forward, that starting point in terms of valuations is quite high. So in terms of some of the recent macro and market drivers, this is just pretty simple to start off with. This is global growth and expectations out to the next couple of years. So what's the expectations around GDP? And I think the takeout from this slide is, look, we're not looking at a recession, but to sit here and think that those numbers are flying is probably incorrect as well. So you can sort of probably look at Australia and say, look, aren't we doing well? We're going to be growing a bit more than what we have in the past. But to give you some sort of idea, that 1% we're sort of starting at today, if you put COVID to one side, is probably like our lowest GDP growth since the 90s. So we're starting from a pretty low base. The Eurozone as well, we're starting to see a bit of GDP growth. Again, pretty tempered rises off what's a pretty anemic type of base. So in terms of expectations, in terms of GDP, look stable, but somewhat underwhelming would be the takeout from that slide. So what does that kind of mean? Well, you know, looking at that, how do markets go higher and rally from here? So one of two things can kind of happen. The multiples could expand out further, or people are happy to pay more for the earnings that they're getting. We saw on the last slide, our starting point's pretty high. It's probably not to say that couldn't happen, but, you know, to sit here and think we're going to get a huge return out of further multiple expansion, I think somewhat is optimistic from that perspective. And on the flip side, you can get your earnings growth, which, you know, in essence, this is why you'd have this chart up to say GDP would be, you know, what, you know, supportive of earnings growth from that perspective. So again, you know, potentially, you know, okay and stable and not kind of recession territory, but again, on the flip side, not rip-roaring higher, if that makes sense. The US economy does, you know, enter 2025 on a relative solid note. One thing we're looking at, or we get from Zurich in Switzerland around, you know, we're potentially going to see a bit of a slowdown in wage growth in the States. So that chart on the right-hand side is sort of the quitting rates of jobs in the US. So unemployment and everything's pretty stable. The labour market looks strong, but it's that, you know, they probably look at it as a bit of a leading indicator of people are a bit uncertainty about their employment situation. People are a little bit less hesitant to start a new job and, you know, walk across the road for a couple of extra bucks. I think interest rates kind of probably feed into that a little bit too in the States, whilst they've had some cuts and come off recently. Speaking to a few of our fund managers in the States, he said it's a big issue there now, attracting talent from region to region, because people can't walk away from their 30-year fixed rate mortgage at 2% and then move, and I'm going to walk into one at a higher rate. So kind of attracting talent and getting people to move is a little bit difficult over there in the US. The services side of things, potentially a risk still on the inflation side. So it tends to be the stickier kind of part of it, inflation. So I'll touch on that in terms of the States as well shortly. Not shortly, right now. But in terms of the inflation, you can see in the US it's come off quite significantly. But, you know, looking at that chart, I'd say it's still stubbornly high of where their target is. So the US has already been through 100 basis points of cuts over there in the States. Inflation still, as I said, sort of stubbornly above where their target would be. I think, you know, potentially looking to the market for further rate cuts as that leg of support. Potentially might be a bit optimistic. So if you look until probably that gets knocked on the head a little bit more, I think, you know, the case for further rate cuts in the States will be muted. So to give you some sort of idea, a month ago there was a 23% chance markets were pricing in a rate cut in March over there. That's now down to 2.5%. So pretty unlikely. They're now only sort of factoring in one cut for the year in the States. Compared to mid last year, the market was pricing in 6 or 7 over that same period.
Tariffs, inflation,
yeah, we'll touch on tariffs. Yeah, look, you know, if they're implemented as expected, you can probably add 0.5% to the inflation rate in the US, which again is going to make it more difficult to get down.
I wasn't there in an announcement that he's going to introduce a further 10% on China.
Yeah, so China, he's threatening another 10%. It's sort of 10% at the moment. China's kind of an interesting one because I think, interestingly, I think the threat to expectations might almost be more on the US side as opposed to China. We had our EM manager out a couple of weeks ago and she was quite bullish because she said everyone's been talking 60% tariffs with China day one, was sort of the rhetoric. So she said it's ended up being 10 and it might end up 20, but it's not 60. So it's kind of better than what was thought or potentially kind of priced in. She was like, I think the potential is people aren't thinking about it if this really kicks off and becomes a prolonged tariff war. Like you were saying, you're probably looking at a 0.5% impact on US inflation, probably a 75 basis point hit to GDP. So is anyone sort of thinking about that from a US perspective is kind of interesting. What we're also seeing is which is probably new, is sort of central bank divergence. So we've been through a period of a long time of pretty much central banks in the world through pre-COVID, during COVID, and coming out of COVID, really moving in lockstep with each other. We're probably starting to see those central banks diverge based on what's going on in their underlying own economies. So we've talked about the Fed, potentially being on pause this year, or maybe only having one cut. The ECB has been cutting, which probably feeds into their bit of anemic growth they're having in GDP. Australia, we got our first cut. Japan, their inflation rates rip roaring away. They're even sort of talking about rate rises now. So again, I think it's just something that probably adds to volatility looking forward, having that divergence.
You got some questions here, Rob?
Well, no, that was from before. That's
That's been there for a while.
Okay, sorry.
Since it's up.
And then on the flip side, bond yields remain pretty elevated despite those muted growth forecasts. So if you think about the cuts we've seen at the short end of the curve, it hasn't really had a huge impact on the 10-year bond yield from that perspective. So what do you take from that? I'd say, look, the market's probably not convinced that inflation story is completely under control. I probably shouldn't say this as a guy who's here promoting mainly equity funds, but if there'll be many out there that would argue the bond market being a lot more institutionalized than the equity market. Some would argue it's potentially more sophisticated than equity markets. They're telling you that they're not convinced that inflation story is kind of completely under control. Moving on, I think this is probably one of the more interesting sort of charts and probably feeds into where we lead to in terms of some broader kind of growth opportunities. I'm not sure from a client perspective if the Mag 7 and market concentration kind of hits their consciousness, but I know kind of in terms of investment markets and working in this industry, it's been a incredible couple of years in terms of that narrow subset of stocks driving returns. And you can see from this chart, there's been a reason this has happened. So 2023, the Mag 7 saw 32% growth in earnings. The other 493 companies had negative 4% earnings. And again, in 24, similar sort of story, 33% for the Mag 7 and 4%. So going back to the Schiller PE ratio, this is probably a really different story to the tech wreck in terms of, yes, we're seeing these elevated valuations and outside returns from pockets of the market, but there's a earnings sitting behind it from this perspective than others. But interesting from here looking forward, expectations around earnings, you won't see that completely reverse, but you are seeing that gap between the Mag 7 and the others closed significantly. So, you know, you were looking at the 29% gap last year, expected to be around 8% this year, 4% the year after. So, expectations are for a significant kind of broadening out of market returns and where earnings will come from in terms of the index. So, you know, and then if you overlay that with the PE side of things, you know, on a forward PE, your Mag 7 are probably sitting at 38 times. Granted, you've got Tesla at 120 and you know, others looking a lot more reasonable, but as that as a starting point, if you then looked at just an S&P equal weighted portfolio, forward-looking PE, same metric, you're looking at 21 times earnings. So if you sort of piece those two together, the starting point in terms of valuations and the starting point of the broader market and what those expectations are in terms of earnings growth, we believe there'll be a lot more attractive opportunities beyond the Mag 7 looking forward than we've probably seen over the last couple of years, if that makes sense. So policy initiatives, as I said, sort of Trump's hit the ground running. 4 weeks in, he's had 108 executive actions. I'm sure there's probably a few more that have been done since now.
I'd like to know how many Biden did in his whole term, like just as a comparison, but you know.
But a lot of these aren't legal and they're being contested by generals and all over the place. So.
Yeah, so we sort of touched on the tariff piece already. Look, in terms of the broader global market, the biggest impacts will be on Mexico, Vietnam and Canada. Not a huge impact in terms of if you looked at global markets and where the index looked, if you're looking at a whiskey or something along those lines. Yeah, as you said, Darren, you know, 10% locked in for China, potential for another 10. They're talking 25% for Mexico and Canada. So this is obviously watch this space. As I said earlier, we think probably the impact in terms of China and emerging markets is well understood and built into expectations. Probably the impact on the US side, if it continues for any sort of length of period, maybe potentially not as much.
I would just make a comment, probably something to continually ask the investor and all the analysts is, well, if the other party got in, what would have been the impact on the share market side of things? Because it seems everyone has quite the negative sentiment for Trump, but to be honest, I don't think they should be complaining too much if they've got money invested, because market's done pretty good since and rallied. But you know what I'm trying to say, like if the other party actually got in, well,
yeah, I mean, I don't think Trump and its core, and you know, we'll touch on a few of the things now, some of the market facing initiatives, but some of the things on this screen are probably come to your point of why he's probably considered a bit more pro business than the Biden administration.
Clients coming in, wish you didn't get it, or not literally wish, like it's got no impact on it, literally, because we don't live there.
Mm-hmm.
But you know, obviously the markets have rallied pretty well in that period. You just like to have a little comparison and say, all right, well, if the other party got in, well, you know, you might have been down 10% instead of up.
Yeah, well, I mean, there's a couple of things here. I think areas of interest are financial services and deregulation to us. You know, it's interesting speaking to both our global managers that they're kind of like, yeah, we came out of the, you know, GFC here in Australia, and you've got your big 4 banks and you came through relatively unscathed in the whole scheme of things. But, you know, the backdrop of what happened in the US off the back of that's probably still being felt now in terms of regulation, the amount of capital they have to carry as financial institutions, red tape, regulation, all that sort of stuff. So it is sort of one area American Century have found interest with, seeing opportunities in financial services that, they think are well positioned to have sustainable growth over the next few years, as some of that's kind of pulled back. Trump's already talking about kind of, I would be rushing out saying this is a great thing, but curtailing some of the consumer protections and the like that were put in post GFC. So around the edges, you're going to see a lot of that stuff sort of watered down a little bit, probably just allowing these finance banks, etc., to be a little bit more nimble, execute on stuff as what they kind of had in the past. Energy deregulation is probably another area. We're probably a little bit more kind of skeptical on this one. Oil price at 70, no matter what you do in terms of red tape, I think it's probably still a little bit problematic to have the corporate side jump in and unless the price is a little bit higher. But he said, even speaking to some of these fund managers, and particularly in terms of some of the gas and all this stuff that goes on, he said the experience from the Biden administration was, look, they wouldn't come out and say we're outright not going to let you do something, but the reality is you'd be made to jump through so many hoops that stuff would get delayed, pushed down the road. They just made it extremely difficult for a lot of this stuff to happen. So again, we think around the edges that becomes easier to do. We were discussing at lunch, Trump's big mantras, America first and bring manufacturing back to the States, and energy prices kind of feed into all that. The other interesting one, in terms of the corporates is the, corporate tax rates. So in Trump's first term, he lowered the corporate tax rate from 35 to 21%. We think one of his first steps will be to push that out and increase it further, but there is talk that may come down further to 15%, which again is going to be beneficial on the corporate side of things, and again, making America a more attractive place to do business, which
bring money home.
feeds into what he's doing. So
His company will be a bit.
Middle America.
yeah, so around the edges,
Good revenues.
there's some of the areas that should be good for corporates. Again, I'm not sure we're completely convinced about this one as a peace dividend, but some people would argue that if Trump manages to settle stuff down in Ukraine and Gaza, is that a boost for markets when the geopolitical side of things calms down? Who knows? But I wouldn't be banking on that to be a huge driver of returns.
Russian assets that all of a sudden are assets again that were marked to zero.
Yeah. Well, it'll be interesting to see when some of those.
I don't think.
I digress. We had our EM manager out. We've launched an EM fund, and she was out a couple of weeks ago. So we were all asking her about the experience through the Russia-Ukraine war, and she said we've got an analyst, Svetlana, who was born in Russia and obviously grew up there. And she said when investing in EM, you sometimes have to make some pretty bold calls on the geopolitical and country spectrum. And she said, I was away on leave, but the co-PM was there, and Svetlana rang up 4 days before they invaded and said, there's 190,000 troops on the border. She said, I don't think this is a training exercise. You need to sell every Russian stock you own in the portfolio. And she said, we managed to get most of it kind of sold. And she said it kind of got to Thursday and there was a big % or two left, and she was just taken off limit, just sell it for whatever you could get. And
You got out, kept your shirt.
yeah, so it was and an interesting one, but that's even our thematic guys, they had they've been around since the 80s, been managing money. They had experience with a Russian oil company back in the day that was repatriated back by the Russian government. They just decided, right, it's not a listed company anymore. We own it. And I think they said we'll never invest in a Russian stock ever again. But yeah, I digress. Look, I didn't want to spend too much time on product. I just quickly wanted to touch on why we find some of these other areas of the market kind of interesting. American Century, look, they're a growth manager. They have a little bit of different definition of growth, but their belief is a direction in a company's earnings is more important than what the headline number is. So a lot more interested in a stock going from 7 to 15 to 22, as opposed to one that's growing pretty consistently at 20%. So in the context of some of the opportunities we'll touch on in a minute, you can see from that first chart and the earnings growth out of the other 493, they're for the first time in years kind of saying, look, we're finding a whole heap of exciting stuff that's inflecting, as opposed to, oh, we're scratching around to try and find stuff to put in a portfolio, if that makes sense. Skip through a couple there. It's got a few of the other areas, including AI, but beyond, that they're finding interesting. I'll touch on power generation and distribution in a minute. Japan's an interesting one, the digitalisation of Japan. So there's a few IT stocks in the portfolio from that perspective. I didn't even realise this about Japan, but you kind of think normally I'm seeing portfolio managers own cutting edge robotic stocks, and you think of Japan as a high tech kind of country, but in the corporate landscape, they're probably one of the last countries on the planet still using fax machines. And so there's a lot of government initiatives to kind of bring the Japanese corporate world into the 21st century. We touched on capital markets and financial services. I'll touch on some other aspects of EI. One that we've dropped off that's actually been quite interesting. We've owned quite a few stocks and it's not there because they've been sold for valuation and done quite well, but a lot of stocks in the second-hand aerospace area, which again, people might think of a growth area, but that did quite well out of second-hand aeroplane parts, which was quite interesting. But
Yeah.
and it's interesting if you look at the 5-year attribution on their fund. Nvidia's obviously the first. I think the second best performing stock is Helmet, who make parts for turbine engines for aeroplanes. So quite different from that perspective.
People stop buying from Boeing, have they?
Well, that's in essence their business model. So if you buy a plane from Boeing, you're under warranty for 10 years. After that expires, you have the opportunity to either go back to Boeing and buy your spare parts, or go to a Helmet that in essence will do it 30% off.
And probably
And in a way, airlines are run and Qantas, etc. They're under a lot of cost pressure, so they're just a business that have been picking up market share pretty kind of consistently. But just wanted to probably touch on a couple of areas of, a lot of talk around AI. I think most of us here in Australia, if you've been a shareholder of Goodman Group, are pretty happy with the data centre side of things. We were discussing at lunch some of the interesting areas, power generation and expansion of energy sources to really fund the energy needs of this AI kind of revolution. So global demand for data centres, they expect to double from 22 to 26 in the space of a few years. Data centre share of total power usage in the States is expected to grow from 4% today to 12% by 2028. And that's going to lead to, for the first time in a long time, a significant increase in the total energy load needed by the US. So I had it in the other presentation. I haven't got the graphic, but in the 1950s, the energy load in the States grew at 9% per annum, roughly. So the advent of appliances and all that sort of stuff. Aircon came in the 60s and it continued to grow at 7.4% per annum. 70s had dropped to 4.7, 80s 3.0, 90s 2.4, and then in the 2000s we saw energy efficiency, LED lights, all this stuff came in, and growth in total US power has been less than 1% from kind of the end of the 90s to today, over 25 kind of years. What you're going to see from here on in is that kind of pick up to 3% this year and start growing again at sort of 3% per annum over the next 5 or so years. Pretty much being generated by that demand for power for AI. So everyone talks about all the great kind of uses of it. If you do a single AI query, that takes 10 times the energy of doing a Google search in essence. So as all this moves to AI, the power to kind of run it's going to be quite extraordinary to make it all happen. I've just put a stock example there that's sort of in the portfolio. A pretty good example of someone tapped into this, but it's a business called Dominion Energy. They're based in Virginia. So don't know if any of you have looked into data centers, but Virginia is the data center capital of the planet. They have more data centers there than, the next, I think, 5 states and the next 4 countries combined based in Virginia. Now, that's based on a few reasons. Firstly, they've got extremely cheap energy. They're in a pretty good position near the eastern seaboard with the fibre optics, etc., going to DC and places in the vicinity. And the state government over there's been very proactive in making it easy to do business in terms of Virginia, and it's been a rip-roaring success, as you can see there in terms of the charts. So currently they get their electricity's 50%, 57% gas, 30% nuclear and 6% renewables. And Dominion run sort of three nuclear power plants in the vicinity. So you can see their contracted capacities grown quite significantly. Again, this business is coming off very low single-digit growth. That's going to get to 6 or 7, so it's never going to be a 30% company, but in terms of that inflection and where it's going to, it's quite kind of interesting. 75% of it's sort of carbon neutral energy that they produce, so again feeds into that. But the other aspect to the business that is potentially kind of a free option in terms of what else is going on is they've entered into a memorandum of understanding with Amazon to explore. They won't be building them, but Dominion potentially will enter into a contract with Amazon to service semi-modular reactors. So I don't know if you've sort of heard much about them. Obviously, they've got the big nuclear power plants that they run in the States, but these smaller nuclear reactors can kind of be built in a factory, shipped on site and set up close to the grid or wherever the data center wants them, kind of like a mini nuclear reactor. And Dominion will, potentially enter into contract to service those and keep them running. But there's a lot of interest in that kind of space. There's another business which we don't own, but NuScale Power is a business over there in the States that's more involved in the building of these small modular reactors. So in terms of all those energy needs, we think that will be a trend going forward where you'll start to see these pop up more and more in terms of the states. I'm not sure it's flying in Australia where we currently kind of sit, but we'll see where we end up if push comes to shove.
Do you know what? Sorry, probably not on this slide because it's just US. Like what or how Goodman Group compares, like in terms of size or.
In terms of market cap, I can get back to you on market cap. Obviously, they're more involved in building the infrastructure of the
Yeah.
data center as opposed to providing the energy to run it. So
Yeah.
slightly
Okay.
different part of the
Yeah.
same, obviously,
Yeah.
sort of AI beneficiaries and
Yeah.
chain, but Dominion's more
The energy.
feeding the existing data centers the power that they need, as opposed to kind of Goodman would be more involved in the,
Yeah.
in the construction,
Yeah, no, that makes sense.
construction of them. But as you can see, that's
Yeah.
been a huge success story here in this country as well. Another one we find quite interesting in a similar sort of space is another business, GE Vernova. So they're actually involved in the production of gas turbines. So traditionally, if you looked at most data centers, they'll plug themselves into the grid. And then if something goes wrong, they've got a diesel generator in the background to keep stuff running. GE Vernova makes gas turbines. Actually, the technology comes again out of jet engines in essence. So these gas turbines are modular, easy to install. They can run off gas or liquid fuel. You can actually have some that the newer ones will actually run off hydrogen if the energy heads that way in the future. But a single unit will replace 10 to 12 diesel kind of generators. So full disclosure, this is one we have, owned in the portfolio. If anyone's tempted to run out and trade on personal account, just in terms of full disclosure, it is one that we've been trimming. It has done quite well. Speaking to the fund managers, they're kind of like, we believe the sustainability and the inflection's intact, the long-term story is kind of intact. They're just saying, look, has done very well and it's got quite expensive. So it's weighing that up. It's probably a bit less attractive than it has been in terms of the past. But again, another beneficiary of the AI wave that again isn't a AI or a tech stock, a different kind of segment of the market. And finally, I'm not actually sure that we don't do any private asset funds, but I'm sure your advisors these days are kind of bombarded with more private credit strategies. Speaking of net wealth recently, I think in terms of allocations on net wealth, allocations to private assets have gone from 4 or 5% to something like 18% on their platform over the last few years. I won't get into the whys and wherefores of whether we're going to see some blow-ups in that space. Time will tell. But obviously, there's a periphery of managers in this space coming to market. As I said, we've got one there again in the financial services space. Specialising in sort of private credit. You tend to see a bit of a lag in these businesses between interest rates and higher performance fees. So we still think there's a inflection there, as well as accelerating fund and inflows in terms of that. But one sitting outside the AI space, but we're finding quite a few opportunities in financial services. I think that's really time, but just to wrap up, summary, growth relatively stable yet underwhelming. Inflation remains stubborn, above target in the States. Policy initiatives being digested by markets, though who knows, things can change with Trump. We think opportunities more broadly exist outside the Mag 7. Full disclosure, we still own 5 of the 7. It's not that they're not going to potentially do well. We still own 5 of them. I think 3 of them you'd class as extremely high conviction, being Meta, NVIDIA, something. Google and Amazon are the 2 that we potentially see exit the portfolio, depending on conditions. We don't own Apple and Tesla. Meta is probably the pick in terms of the one that's been able to harness AI. So within these stocks, you just still see massive CapEx being pumped into AI. I think the question over the next few years is how are you gonna monetize that and turn it into money for shareholders? And speaking to the guys, they, broadly think, Meta is the one that's been able to sit there in meetings and say, we have done this, we've put AI into our reels, engagement has gone through the roof. Booking,
Add some more targeted.
yeah, and you're kind of seeing it. Booking.com is probably the biggest ad online spender on the planet. They're diverting ad spend to Meta because they're seeing the results out of how they've incorporated AI. Whereas I think in terms of the other businesses, they're like, well, the jury's still out. You're kind of spending a lot of money, but we haven't quite seen how you're turning it into shareholder return yet. So, yeah. And Google, Amazon, I think that we still like both of them. They're still in the portfolio. I think going forward, the view is they might be a little bit more exposed to cyclicality in the market than they have in the past. I think for the last decade, we've seen a whole flood of money move from traditional advertising to online. So the cyclical side of it probably didn't matter as much because they were taking market share from print and TV and all that sort of stuff. Now that it's probably got to a point where it's potentially kind of capped out, that structural piece is coming to an end. So the view is they might potentially be a little bit more exposed to cyclicality in the market than they have been in the past. But for the time being, they're still seeing things inflect and happy to kind of still be there. The other two we don't own. Tesla, you could argue, yep, there's inflection there. Just struggle to get my head around valuation. So we've never owned it. Apple's been owned in the past, but it's probably the one that's bemused the guys the most in terms of the fact that earnings haven't been growing. But it's still been going up in terms of Mag 7. So
That Amazon point, separate fund, probably one of your competitors, they were pretty bullish on Amazon in particular.
yeah.
Where their CapEx has been going into, or from what they mentioned, including like their retail sector over the years, and now it's started to go into more the web-based. So I'd be interested to see like why they're so bullish on that. About they think it's undervalued in comparison to the 7. Probably the whole market, but just in comparison to the 7, they were saying that out of all of them, that was probably the most undervalued.
Yeah, we're on two portfolios. We're on a 100 stock portfolio and a concentrated 35. Amazon's still in the 35, whereas Google isn't. So you'd still consider it a kind of higher conviction name. But we kind of asked them the question like, what would it take for some of these to not be in the portfolio? And it was kind of like, we think it could potentially be exposed to a bit more cyclicality. We haven't seen it yet. It's still in the portfolio. It's still meeting the inflection and acceleration that we want to see. But suspicion is if there was an economic downturn, it might be more impacted than some of the other of the Mag 7.
Yeah, you use the point of the advertising with Google and stuff, and now that it was obviously getting all of that advertising moving, I guess we've again been to the point of Amazon, like the retail side of the business and everything like that. If there are more people have been gravitating more to online shopping, and how much more can online shopping get to? Does it cap out at a certain point? And then if there are cyclical changes in the market, that's maybe like the retail side of things or distribution even. I don't know. I think it's the advertising end.
Time will tell. Yeah. It's not sure what on the Amazon side of things, but they were, the American Century guys were saying, in their opinion, Meta's been the one that's been able to point to how AI has driven revenue better than most other businesses, which
It's primary business as well.
it's quite scary, to be honest, like, some of that data around the, I've got kids that are on reels and doing all that sort of stuff. It's actually quite disturbing, the uplift in engagement and how they're spending and what the impact of AI's been on that. So, you know, yeah, when it's makes the money, he's kind of like, you know, what point is it a ESG consideration damage you're doing to, you know, kids and the like, because it's, you know, it's great for making money and selling stuff, but, you know.
Getting targeted.
So it's, yeah, even, how do you describe it? It's like not even selling stuff that you want. It's like selling stuff that you think you might want, and like it's getting.
It's creepy stuff.
Yeah, yeah. So it's interesting kind of space. No worries. Thanks for that, guys. I hope there was a bit
Thanks, Ray.
of interest in there.
You. We will jump out of this session and jump into the next session. Oh, here she is, Kira. She's just about to walk in. So those online, we'll see you back in just a couple of seconds.
Level 30 at night plus, man, will be ads. That's at this point. That's all that pops up.
Yeah.
You just like, oh, great.